Intellectual stew. Intellectual stew with James Kirkland.
Powerful and provocative, prophetic and practical,
Intellectual stew.
informative and inspirational. How you gonna do better if you don't know what better looks like? I do.
Intellectual stew.
Come on, let's talk about it with me, the mind massager.
Intellectual stew with James.
All right. All right. What's up? What to do? It's time for another episode of the Intellectual Stew with yours truly, James Kirkland. And we are getting ready to talk about insurance with Chris TInsman. Let me go ahead and bring her in, and we'll go ahead and get this conversation started right now. How are you doing, Chris?
Hey!
Good. You can hear me this time.
Yes,
Last
sir.
time you said, I can't hear you. I can't hear you. You said it like 45 times. I can't hear you. I can't hear you. I'm like, I know I hear you. But we're good now. So we're going to talk. Glad to have you back. We try to get you to come in typically about once every 2 or 3 weeks, 3 or 4 weeks, and talk about some aspect of insurance. And we wanted to do that again on this morning. How are things going for you? I know you're caring for your mother, so we're definitely praying for you with that regard.
Well, thank you. That's fabulous. Everything's going great. And, status quo, we're still working.
Still working. That's all you do is work, for real. But it's evidence, though. It's evident, and you definitely receive the fruit of your labor. So let's just go ahead and get into it. We've the last few times that we've talked about several things. We talked about insurance, permanent insurance versus temporary insurance. Talked about what a death benefit is. Talked about how it's important for every man or every adult to make sure that they've provided means for that in the event that they were to pass away. And the way to do that is by using insurance. And culturally in our culture, I know in my culture, one thing that we've always been taught is that insurance really only pays you when you die or when you pass away. And what I want to teach my audience, and with your help, and I appreciate you for your help, I want us to be able to teach people that insurance does not only have to pay you when you die, but insurance can be used in other ways as well. Correct?
Correct.
All right. And so today, what we're going to talk about is how to use life insurance to retire, if that sounds good, to retire your debt faster. That doesn't, I would have never thought of anything like that you can actually use life insurance to retire your debt faster. Explain that concept to me and take your time because we got people that are coming in. Let's explain. How do you retire your debt with life insurance?
Okay. So when I talk to people, you have what's called a bank. It could be a BB&T. It could be a First Citizen. So there's their little clips. It could be any bank that you use, Wells Fargo, you name them. The problem is that they charge you to borrow their money, and they make money on your money. And it's a shame that, when you put your money in a bank, that you get 0.25% interest on it, because they're actually, they're utilizing your money to make money. The difference is that if you use insurance the proper way, because it is a tax advantage, meaning you will not pay taxes on the compound interest that's created inside of that insurance policy, as long as you never cash or liquidate that policy. So you're basically turning the tables on the interest that you would be borrowing the money from a lender. And it could be any lender. It could be a car loan. It could be student loans. It could be credit cards. It could be mortgage. It could be medical bills. It could be anything. But you're turning the tables on that interest. And instead of paying the lender the interest, you're paying yourself the compound interest. And that's how they make money. So if you want to be in the minority and you want to create a banking system inside your household, then you need to utilize the insurance products.
You you you. So let me hear it. You said you can create a banking system in your home
Mhm.
by basically combating the debt, the interest on in all your loans. Break it down a little bit more. Act like I'm a 7-year old. So how would this work? How would I if I'm telling this to someone who doesn't really understand finances
Mhm.
like that? You know, they're not
Mhm.
they don't have
Mhm.
they don't have the accounting degrees and they've never really been taught money like that. But
Mhm.
they have been on their job 4 or 5 years.
Mhm.
They make enough money to purchase a home.
Mhm.
Uh, and they're living in their home now. So now
Mhm.
they got just hypothetically, they got $1,000 a month mortgage.
Mhm.
They got a $400 car note.
Mhm.
Got a few credit cards. You know,
Mhm.
now how would you present this product to those individuals?
So, um, how it works is this: we use what's called a snowball effect, but
Hmm.
instead of paying the lender the interest, you pay yourself the interest, which means you are and can pay your debt off in half the time. Because
Okay.
when you're creating additional income and interest for yourself, your cash accumulation grows. So you're basically putting the money into a pot, it's compounding interest, and that bucket fills up. Once it gets to the top, you pay your debt off, you come back and you take the money that was already allocated in your household back into the bucket. It fills back up again, you pay the debt off, and it's repeat rents. The difference is that the money going into the pot is compounding interest and creating cash value. So if you guys have ever heard of Dave Ramsey, well, the difference here is the concept is great, but at the end of his program, you have no cash. The
Hmm.
difference is that at the end of our program, we've compounded the interest inside the SDIC, which is a specially designed insurance contract for your household,
Hmm.
not James Kirkland's household, not Chris Tinsman's household, for the client's household. So what's
Okay.
going on inside of that client's house is how we designed the program. We designed the program to eliminate the debt, not actually adding another bill to your household, but rearranging the
Rearrange.
payments
Okay.
that are going on inside the household.
Gotcha. And typically, how long does this process take before you start to really benefit from the interest? Does the interest kind of grows
It's day one.
simultaneously as day
Day
one?
one.
Okay.
So
And
there's
and
no waiting period on this product, no waiting period for growth. So, like if you just put it into a basic whole life policy that doesn't have any growth on it, it takes 2 years before it even starts growing, before you can even see cash value. This grows immediately. So, we have a product that grows on the front end and continues to compound interest on the back end.
okay, so you used the expression and a minute ago about buckets, and I want you to break that buckets thing down.
Okay.
Is that in this debt free for life thing you just sent me? Should I pull any aspect of that up?
That
But
that is an example of a client that is not named, so we just used an initial, and I kind of did a little bit of a process. But there's a PowerPoint that we use that kind of shows how the buckets fill up, and
mhm.
we go through the process on that. Um, I kind of do you want me to share my screen, or do you want me to send it to you? You want to pull it up and it'll kind of show the buckets on
If
how
you,
the
s-
compound
I
interest.
don't think I have the ability to let you share your screen. But
Okay.
if you send it to me right quick, I might be able to share it,
All right.
and we can kind of talk about it while you're
Okay.
doing that.
Yep.
Listen, while she's sending me that, what we're talking about now is we're talking about how to, for those that just came on, we're talking about how to use life insurance to retire your debt. And what we're doing is we're putting the money into a policy where the interest grows faster. I mean, excuse me, where the interest on our
On the
policy
front.
grows faster
Yep.
than the interest on your
Yep.
loans, and we use that money to pay off the interest on your loan to help you retire your debt faster than you normally would. Chris, typically, if a person's on a 30-year mortgage, how
Hmm.
much time can they trim off of their mortgage by using this program?
We can usually get them out of debt in 10 to 12 years, less than
Wow,
half the time.
less than half the time. Wow. Listen, that just those that are listening. If this doesn't make sense to you, I mean, because the way our economy is going, we really need to figure out how to get out of debt a lot faster because I mean, gas is. Somebody showed me something today. Gas in California is $9 a gallon, or somewhere in that neighborhood. And I don't know if that was true or not. I don't know if it was a meme.
It's in California.
$9 a gallon.
Yeah, that's correct.
Wow.
They said
So-
that it will hit. It'll hit about $7 probably. Probably here shortly.
$7 where?
Everywhere, locally.
Wow.
South Carolina, Georgia.
Wow. Yeah, I got to keep working from home. I can't spend no gas. I'm sorry, I can't do it. I can't do it. Have you sent me that email? Yeah, let me
Yes,
look
I
at my.
have.
All right, let me check my email right quick. Yeah, but yeah. So using words, explain the buckets a little bit for the people.
So
And,
if you, I want to, I was kind of trying to split my screen here so that I could kind of follow along. If you're going to pull up that that PowerPoint, I'll actually tell you, I'll explain to them how it actually works inside the
Okay.
household. And it's a really cool presentation.
Mhm.
And it's very simple, but we only need to go through a couple of, I don't have to go through everything, and then I can show them what the debt report looks like. But if you go and pull up that PowerPoint, and then I need you,
I'm not as smart with this. Hold on one second. Let me figure out how to do this.
because it does say here that I can actually share slides,
does it?
videos. Yeah, it says.
Well, try it.
Share
If you
screen.
can go ahead. You're teaching me something. So if you can do it, do
Sharing
it.
Screen is easier with two monitors.
Do it.
Can you see my screen yet?
No, I cannot. I would
Okay,
be
hold on
lying
a
if I
second.
said that. But I do have you. I can pull it. I do have it though.
Can you see my screen? You're in the show, everyone.
Yeah, I can.
You can see my screen?
your
Oh,
Well,
fabulous.
No, I would have to add it to the stream though. Now I can add it. There it is.
Okay, can you see it? Because I can't. Hold on a second. Let me see something.
I can see it.
You can see my screen. Oh, fabulous! Awesome. All right,
Do
so
you
let me go ahead and load this up then.
I'm gonna remove it until you pull it up though. Oh, there it is. There it is. Good. All right, y'all. I learned something today. Y'all can share the screen. Oh, okay, good. I'm sorry. I got excited for nothing. Yeah, she's gonna explain how to do this debt elimination thing. So you can, if a 30-year mortgage, you can use it, retire your mortgage 10 to 12 years faster.
Yes.
10 to 12 years
In
faster.
about 10 to 12 years, I can get you out of debt. And I'll show you an example of one that we did for somebody before we leave here. So the traditional snowball debt looks like this. This is a typical household. So this is typical credit card debt, student loan debt, auto loan debt. Okay.
Mhm.
And then you've got your credit card debt, your student loan, your auto loan, and everybody's trying to make payments. Well, what we know is that 90% of all households are trying to overpay on a bill. Okay. So let's just say these are the minimum payments. $71, $643, and $413. Okay. Your total monthly minimum payments would be $1,127. Okay, so the strategy here is to take the excess cash monthly budget, so whatever you're overpaying on your budget, and pay it towards your lowest balance account first. Continue this process until that account is completely paid off. And at the time, you then redirect the money that was being paid to the account just paid off, and you snowball it into the next lowest balance debt account. The cycle continues until all of your debt accounts are paid in full. Here's how it looks. So let's just assume your excess cash monthly budget, or you're already overpaying on your bills, $500. So we're not going to take any additional money out of your household.
Okay.
So what we do is we take the $571, because let's just say you were paying $200 over on your car, you're paying $200 on your student debt, and $100 on your credit card. So let's just say that that's what it was. So we take the $571 and we apply it to the credit card. We eliminate the credit card, and then we take the $571 and the $643 and apply it now towards the student loan. So we're making a $1,214 payment towards the student loan. That goes away, and then we work on the car payment. Okay? So all of the money then goes to the car payment. So what ends up happening is you become 100% debt free. Well, what happened during that entire process, you were also compounding interest. So this concept has been around since Albert Einstein. I mean, so think about this. This is how Ray Kroc purchased McDonald's, and this is how the Rockefellers built their wealth inside of their household. Compound interest is the eighth wonder of the world. He who understands it earns it. Think about that. He who understands it earns it. He who doesn't pays it. Which one are you? If you're in debt, guess which one applies to you? That's me. That's James. That's 99% of every household is in debt. Okay, so this is how many people that we can help, and this is how many people we can reach. Here's what it truly does. We use the same process, but instead of paying money toward the balance owed, we deposit the money so we can take advantage of the compound interest in your favor. So what we're doing is we're essentially paying ourselves versus giving the money to the lender.
Okay.
So you continue paying your minimum monthly payments. So you stop overpaying and start paying minimum payments. Then we start filling this bucket up. Okay? Once the bucket fills up, it pays off the credit card debt. Then we fill the bucket up again, and then it pays off the student loan. And then we fill the bucket up again, and it pays off the car. Here's the difference. That at the end of this account, and at the end of you being debt-free and not having any more debt, you actually have cash in your account. Whereas the old traditional way is you're starting from zero again. Mm-hmm. Okay? Now, let me show you. I'm going to show you one other thing because I don't want to get
this is good. No. This is good information because people need to understand this whole compound interest thing. And I'm going to talk about something else once you finish that. And listen, anybody that's listening, if you have any questions, please drop those questions in the chat. Drop those questions in the chat. You might not have a mortgage right now. You might just have a car note. You might just have credit cards.
That's right.
You know, or whatever. But whatever it is, we need to figure out a way for you to eliminate that interest, and we can do that. Go ahead, Chris. Explain that, and then I got something else.
Here's the crazy thing. The crazy thing about this process is that everybody's in debt and everybody wants to get out of debt. Okay. But what I want people to understand is that debt is your enemy. Because think about this, the financial security of our country, we don't even know what's going to happen. The question is 5 years down the road, are you going to be able to walk down the street to any bank and get a loan? I don't know. We don't know what's going to happen. But we just took an example here of one person's debt inside their household. They had 2 car loans, they had a Discover loan, and they had a mortgage. So this is a very typical generic household. They're in debt by $223,000. Do you see where it shows the interest rate that you think that you're paying? Well, that's awesome. That's what you think you're paying. But if you've ever looked at a mortgage loan, you see how their mortgage loan is 4.25%? They're actually paying, if you look over to the right-hand side, 55%. You never pay that 4.25% until like year 15. You're actually paying 55 cents or $55 on every $100 that you're overpaying on that mortgage is going to some lender. Why don't you pay it to yourself? So what we're doing is we're trading the compound interest that everybody's making on you, and you're actually making it for yourself now.
That's smart. Okay.
So here's the thing. So in our mind, so this is why I love this sheet, because it shows you what your conceptual interest rate is. So if you look at this, their interest rate's pretty low other than the Discover card. But if you look over here and you look at the effective cost and you go to the bottom, you see that 41.46%.
Yeah.
So that's like saying this, James, you have $100 in your pocket and $41.50 of that goes to a lender just for borrowing their money. So that means you're giving away $41.50 of every $100 that you have in your pocket. Now, not for nothing, but my thought is this. If I have $100 in my pocket, I sure am not going to give James Kirkland $41.50 because I don't know him. So why are you doing it? That's the question.
Wow.
How powerful is that?
Very
You
powerful.
have $100 in your pocket and 4150 is going to someone else.
That's crazy.
So what
That's
if I,
crazy.
so what if I could put that 4150 back in your pocket? Would you be interested?
Yeah,
Heck yeah.
that makes sense. That makes
Okay.
sense. That makes
So
sense.
if this person does nothing, that 223,000, they will pay almost 100,000 of interest to lenders, which means that their bill is actually, or their nut is actually 321,000.
Mm, 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 mm. Yep, that's how banks stay in business. Biggest ripoff in the world. Biggest ripoff in the world. Or
So
one of the big.
if this person does nothing, they'll be out of debt the way that they're going right now in April of 2041. If they let us help them, they'll be out of debt 11.92 years faster, and they will save $51,689 in interest that they will pay to themselves.
Wow.
And
They could
that
pay it.
will compound over the period of time.
That's crazy.
It's
That's crazy. That's crazy.
unbelievable.
That
So
is crazy.
our software tells us when everything can be paid off. It's pretty massive. Okay.
Mm-hmm.
And I did not create it, so I'm going to tell you it has nothing to do with me.
Mm-hmm.
But here's what I will tell you. At the end of the program, this person in an 11-year period will have $281,000 of cash in their account, because that's what it will have compounded.
In how many years?
This one, I think, was 11. I don't know if it was 11 or 13 years. It was
Wow.
somewhere in that range.
And all they were doing was basically taking the money that they were paying over
The lender.
anyway.
Yep.
Yeah, paying over. So if their mortgage was, if their car note was 300, but they were paying 500 anyway.
Yep.
Then you take that. But let me ask something. What if people are like, well, I might not have the best, most fiscally responsible. I'm getting better though. Pray for me. What if a person like me just pays just the regular amount every month? Can this program still help them? They can't.
It can, if they can find some additional money in their budget to pay themselves, because the idea behind this is to utilize the overage payment inside your household, because what we found is 90% of the people are overpaying. So for instance, let me give you an example. If somebody's making a mortgage payment of $14, or their mortgage payments $1,412, like $1,412, what we find is most people will pay a minimum of $1,500 or $1,600. Most
Okay.
people are trying to make that one additional mortgage payment a year,
Okay.
no matter what. So we just take that money and reorganize it. Also, a lot of people are overpaying on their 401k. So what
Okay.
that means is that if your company is matching so say your company matches 3%,
Mm-hmm.
and you're putting in 6%. My question is, why are you putting in 6%?
Yeah.
Okay. And the reason I ask that question is because if you're putting in what your company matches, your company is essentially paying your taxes for you. So that 3% you're putting in is free money.
Mm-hmm.
Does that make sense?
Yes.
Okay. So the overage 3% that you're putting into it,
Mm-hmm.
you're really only getting 1.5%, because somebody's got to pay the taxes on that.
Yeah.
So why wouldn't you take that 3% that you're overpaying on your 401k and dump it into something like this that's going to pay you back tax-free?
Makes a lot of sense to me.
So we find a lot of people are putting in 9% to their 401k, and their company's only matching 3%. So they're essentially only getting 4.5%, because somebody's got to pay the taxes on that thing.
Somebody's got to pay the taxes on it.
And it certainly isn't the government.
I'm trying to pull up something right quick. Hold on, because I was conversing with a young man last week, and
Mhm.
I think the company might match up to 4%,
Mm-hmm.
and he was putting 6% in.
Right.
And so I kind of did the math for him, and and if he made $1,000 a week, I think, what is it, 60? It would have been like 240.
Yep.
Almost $300 a month, somewhere in that range.
Yep.
He was only 30 years old,
Mhm.
somewhere in that neighborhood.
Mhm.
So what I did was I ran an illustration for him,
Mhm.
and with that illustration, can you see my screen?
Yes.
All right. So I ran illustration for him at $300 a month, and
Mhm.
and I
In an
think I
IUL.
own in an IUL. Yeah, but I
Mhm.
started because he was only 32 now,
Mhm.
and I ran it till retirement age. Where did I stop it at? I think I stopped
65.
it.
Keep going. It's
Keep
the next
going.
page.
Yeah,
Yep, right there.
65. Yep. And at 65, you see his death benefit.
Yep,
It's
zoom in
550.
zoom in on that so they can see it.
Okay.
Can you zoom in on that? There you
Is that
go.
better?
Yes,
Yeah.
that's
Death
perfect.
benefit is $550,000. The account value is $392,000.
That's cash available to him to borrow for
Yeah.
anything he wants.
Yep. And he's only put in $118,000, 118,800. And if he so happens to live to be 72, his account value goes up to $739,000, and his cash value of that same account is $654,000 after only making $118,000 investment.
So
Over,
are you going to bring up the $1 million baby?
yeah, that's what. But I wanted to show. I was doing do it this way. So this is what I'm doing. I wanted to show it this way because he's 32. Okay,
Yep.
and as a 32, and so a lot of people, they're saving $300 a month anyway.
Yep.
They're putting it in the bank anyway, right?
Yep.
So if you're in your early to mid 30s, your 20s, all this types of range, and you don't have, because I mean, I've been calling you in the last couple of months, and my friends are in their 50s and they
Yep.
haven't done anything, and all of them, in order to see any kind of growth, have to put $1,000 in almost,
500 to $1,000
$500 to $1,000 to see some growth
because they're behind.
within the next 10 to 15 years. But this young man, because he's only 32,
Mhm.
he can put $300,000 in, and you see it right there. If he lives to be 72, his account value goes up to 739. Can y'all see I highlighted that? $739,000, and his cash value is $654,000. So that he can borrow against, you all,
Mhm.
borrow against, and still keep the same death benefit. This is what I'm trying to teach you all. You can use insurance to help you while you're alive. You don't always have to wait until you pass away. It's a way with this whole compound interest thing to
Yep.
show you how to do it. Now, what we're going to do now is I'm going to show him your $1 million baby. Okay. So you can
Okay.
explain it. Okay.
Yeah, I will.
Yeah. So listen, now that was him at 32, putting $300 a month in. That's another little small car note. That's a small car note, no doubt. That's a small car note. But if you start a child as a $1 million baby, as a baby, I'm going to show you Chris's. Where is it at? Where is it behind that preposition? Okay, there it is. Boom. So let me scroll down.
Yep, zoom in on that.
What page do you want me to zoom in on? Same thing?
Go to the top first. Go to the first page because I
All
want to
right, so-
explain the whole process to them. So zoom in
Okay.
on that for me.
Okay.
So this person's going to put in $50 a month, and it's a 2-year-old. Okay. And if you scroll down just a little bit, they get an automatic death benefit of $50,000. That's automatic death benefit.
Oh,
I mean,
sorry.
I hope you never have to use it, but it is what it is. Okay. Stop. Oh,
A little
go
bit
back
right
up
there.
to the first page.
Okay. A little bit
So
more.
it says right here, I want you to understand that when you start this at a young person's age, $6.75 of that goes to the insurance.
Okay.
Okay. I want you to see that. That's what the insurance cost. So that means that the other, it's $93.25 is going to a savings account.
$43. You only do it $50, right? $43.
Oh, yeah, 50, sorry. $43.25 is only going to a savings account. You have to think about it like that because what is the benefit of it? Now, go down to where I've run it. This guy said, well, I want to teach responsibility to my daughter. And I said, that's awesome. I said,
Okay.
that's the greatest thing that you could ever do. And he goes, so what is the retirement age? I said, well, retirement age is 67. So I actually ran this to 67. And this is what he said to me. He said, Chris, stop right there. So he said, Chris, I'm going to teach her the importance of finance. And if at the age of 20, she can't afford to put $50 away, then she doesn't need the policy.
That's
and he
good.
said, I will continue to help her fund it, or I will take the $50 out of her paycheck, and put it in there, because you'll never get the opportunity to only put $50 away ever again.
Mm.
And think about this too. We talked about this on the debt-free, the Labor Bureau of Statistics, when we showed the pie chart.
Yeah.
40% of everything that you make in your lifetime will go to taxes, whether it's to state tax, federal tax, tax on a pack of chewing gum, or tax on a loaf of bread. You will pay 40% of all the money that you make in your lifetime will go to taxes, and you can never get that money back. So why not put it into a place where you can get some of that percentage back and pay yourself?
Yeah.
Okay. So let's go down and remember, this is going to be $600 a year that's going to be paid into this insurance product, which her death benefit continues to grow. But let's go down to where I showed a retirement for this young lady. And that's
62?
going to be at age 67.
67, okay.
Okay. So because we're going to do the math on all of this, and I'm going to have, okay, so right there. Now I need you to zoom in on that.
Okay.
Zoom,
Ooh.
zoom. Okay.
Screw-
So first I want you, no, that's okay. That's fine right there. No,
Okay.
go back to
Okay.
the left. I want to start on the left-hand side. So over the course of 65 years, this young lady is going to pay into this policy $39,000. Let's
Wow.
do the math on this. So let's take $39,000 and let's just say she's in the highest tax bracket. So remember, the money that goes in is taxed. So $39,000 times 0.33, let's call it 33%, is only $12,870. That's how much taxes that she will actually pay
On 39,000.
on the $39,000. That's it. As long as she never cashes this policy out, she'll never pay another dollar in taxes, not even on the compound interest, which is key here. Because if you notice, go to the right-hand side, she now has, at death, if she dies, $841,077 goes tax-free to the family. Because remember, a death benefit is never taxed.
That's right.
Up to a certain amount of money. I think it's didn't they raise it? It was like $6 million or something now. I don't know. It used to be $4. I don't know what it is, but that's really not important here. I mean, it is for people who are at a higher echelon, but for us, basic middle income America, this is a concept that you need to start utilizing. So let's go back over to the left-hand side. I have her taking income because I believe that Social Security will not be here when she retires.
Mm-hmm.
And I have it going at $70,155 a year. That is her income for life. I ran it
68 years. Wow.
So let's go down a little bit on that left-hand side, okay? And let's stop at age 82 because that's where the next stop. This policy, so go over to the right-hand side a little bit, so I can see the right-hand side death benefit real quick. Okay, so stop. So her death benefit is $526,944, and you see that the cash value has decreased. It's only now at $427,000. But go to the left-hand side. This policy has produced $1 million of income to her. Now, let's talk about that $1 million. Let's do the tax on what it would have cost her if she had it in a 401k. And let's also remember that if this was a 401k and it had $1 million in it and you started taking it, it would stop growing. So you're not getting the compound interest on it anymore, and it's not in the market.
Wow.
So it stops growing. This one continues to compound interest based on the cash value that's still in the policy, which increases the death benefit. So on $1 million, and I know you guys know this, but let's just do the math on it. That's $330,000 that goes to the government. So I don't know about you, but I want to be the one that only pays the $12,000.
That's crazy. Y'all have to see the highlights of this policy. I mean, number one, you're only doing $50 a month because you started them so young.
Right.
Number two, you've only paid in $39,000 over that 60 years or whatever it was. 65 years
for her.
65 years. So that means as an adult, you're still only saving less than the cost of a cell phone bill a month, $50 a month, and it's compounding interest. And listen, when she retires, we have her showing an income of $70,000 and 150. And listen, no, typically later in life, at this point, you usually don't have a mortgage.
Mm-mm.
Usually your debts are gone. So if you got $70,000 coming in the house
Mhm.
in income,
Mhm.
and you still have, I mean, look at, I want to go back up here and look at something. Where is it at? If at the age of where was it at the age of 67, 67, I want
67.
to, yeah,
Yep.
67.
65 years in. Mhm.
If they were to pass away,
Mhm.
$841,000
Mhm.
goes to the family. This is not a term policy
Nope.
where something has expired. The
Mhm.
family is going to get that $841,000 can create generational wealth for some families. So
And
that
think about this, James. The entire amount of money that was invested here is $39,000.
that's it.
$39,000 generated over $706,000 worth of cash value.
Wow.
How powerful is that?
That's powerful. And the thing is, and I want y'all to understand something. We don't make an astronomical amount of money on these
No.
types of policies.
No.
We're doing this to help you and your family create generational wealth, infinite banking for your family. Number one, you can retire your debt 12 to 13 years sooner using compound interest. What's that quote that you said? What was the quote you said? What was it Einstein used?
Yeah, Albert Einstein. He who understands it. Yep. That's the one.
Compound. Quote the whole. Say the whole quote.
You want me to pull it up again?
Yeah,
You wanna read
pull
it?
that up again. I want them to see that. I want them to see that quote again.
One more time.
Yeah, pull that because he who understands compound interest, I almost
Earned
got it. What's up,
Earned
Josh? Yeah, huh? Yeah,
Earned it.
let me let her pull that back up. But
Yep.
this is crazy. Parents, I wish I had known for my children, but I promise you I'm gonna have them doing it soon.
Can you share
But
my screen again?
yeah, here it is, right
Okay.
here. I got it.
Because I'm going to pull this up.
There you go.
So
You want to show me
he
you want to show the
who-
dogs? That's what that is. I knew what you want to show your
No,
dogs.
he who
I knew you want. She's advertising her dogs. That was free advertising. I'm gonna send you an invoice for that one. Listen. She breeds labs. I mean, real. I mean, high level. I mean, real with major pedigrees and whatnot. Aren't they hunting dogs and all that kind of stuff as well, Chris?
Yep. Hunting dogs and all kinds of competition dogs. We do it all. Yes, sir.
Yes. And I heard about. It takes Kristen to tell me about how much she loves your dogs. How much she loves your dogs. Here this quote is. I wanted y'all to see this again. There it is. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. That makes sense. That makes sense. Compound interest can change your life. It's like a snowball coming down off a hill. If it starts at the top of the hill, as it goes down, it gets bigger and it creates momentum. I'm gonna show one more, and then we're gonna get off of here because I've had a good time tonight. I've had a good time so far. Let me take this out of the stream. But I want to show one more, and this is a little bit different. Chris showed you one at $50 a month, and they paid on it for 65 years for a 2-year-old. I want to show you this one. Oh yeah, we're in good time too, Chris.
Yeah.
I want to show you this one. Where is this for Ashley? And this is for a 4-year-old. Let me go back up to the top. So, like she said, the death benefit on this particular policy is, I got to zoom it in a little bit, $99,000, $99,125. That's the death benefit. Now, this one's a little different because we're paying in $75 a month. It's not paying $50 a month. Child's a little older, so it's going to show a little bit different. But here it is. Oh no, I forgot to show what the small pay, what the initial.
I think it was
cost of insurance is $14.37 a month. Is what that policy actually costs, right?
Mm-hmm.
But when you come down here, so this is on a 4-year-old. Now, all I did on this one was I let him pay $900 a year for 30 years. Mm-hmm. So at the end of 30 years, if y'all look at it, he's paid in $27,000. Come over here to the right. Right now, it's only a cash value of $72,000. $180,000 is your death benefit. Now, but I want you to understand the powerful. But we talk about the snowball going downhill, right? So if you look all the way down the rest of this thing, let me use my arrow. It makes it a little easier, doesn't it? All right. He makes no more payments. Oh, let me make it a little smaller. Hold on. Here we go. He makes no more payments on this policy. Yep. At 34, He just stopped making payments, still at $27,000. But look on the right side of the screen. That death benefit is going up, and the account value is steadily going up.
Mhm.
At 44, the account value is $150,000. Death benefit is $343. At 54, the account value is $312,000. Y'all see that? And the death benefit is $512,000. At 64, the death benefit is $811,000, and the cash value is $654,000. When he gets 70 years old, now the difference with Chris had loans coming out. I didn't have loans coming out. I'm just showing the overall account value.
But
But at
James,
70,
it's so funny because I think if I'm not mistaken, at age 65, it was like 811,000. It's almost the identical cash value growth.
yep.
You just put your money in sooner than the
Yep.
other person did.
I put almost, you were putting only $600 a month. I mean,
Yep.
$600 a year. I was putting $900 a year is what it
Yep,
basically boils down
exactly.
to. And so when he gets to 70 years old, I just want them to see this, Chris.
It's
At
crazy.
70 years old, this is crazy. And this is off of, let's put $900 a month in for the child. At 70 years old, look at that. The account value is $1,019,370. The death benefit is $1,182,470. Now, let's explain this to them also, Chris. If they take out loans over their policy, all we do is we just take the loan. They just take the loan cost away. I mean, what we've taken out in loans away from the death benefit.
Yep.
So if you had, go ahead, explain it.
So here's how it works, guys. When you loan money to yourself, you can either pay it back or you don't have to pay it back. Whatever you don't pay back, two things are happening. You're still compounding interest and cash values, so the cash is still continuing to grow, which is offsetting some of the money that you loaned yourself. So even when you die, whatever money you took from the account, you don't have to pay back and they still get the death benefit. But if you take it out early, what will happen if you take the cash value out? Then if you die, you don't have to pay yourself back in the beginning stages, but they take the loan off of the death benefit only.
Gotcha. I got you. All right, so we're about to wind this up because this has been really, really good information. If anybody's on now and you have questions, ask those questions. So another question right here. So to get the most growth, how much would you recommend for someone to be putting in their 20s?
Well, I think, when we talk about the two products, two things have to happen. So the retire your debt product is different than the growth product, the retirement product. So
Gotcha.
the retire your debt product is a safety guarantee, and the retire your debt program is something that you have. I mean, the retire your debt program has the safety, high growth on the front end, and then growth on the back end. And it's got security because it's got a guarantee, because we want to guarantee that your debts are paid off. On the retirement plan, you're going to be able to stay in the product for a longer period of time. So you're going to be able to accumulate cash value at a higher rate. I don't want to say it's riskier, because it's not, because you can't lose any of your money. That's the beauty about the products that we work with. We don't like anybody to call us and say, hey, I lost money, because that's not what we do. We're safe money managers. We like to help people, but I think there's an age bracket depending upon what product you're using. If we're looking at a retirement bracket, this is what I use. From age about 20 to 30, I think you need to put in $150 to $300. I like the high end of it because I think you can afford to rearrange your money and not put so much into your 401k. That's just me, because I want to see people. I want to see people have success. I want to see people not struggle and get out of the same rat race that they're in, because right now that's what we're in. We're in a rat race. We live from paycheck to paycheck, and we want to leave our kids better than we found them. Okay. So this is a generational thing. And this is also education. From age 30 to 40, I think you need to be putting in between $300 and $600 a month.
30s to 40s. 30s to 40s. You said $300 to $600 a month?
Yep, $300 to $600 a month. And I think that makes more sense. And if you're 35 and over, it needs to be higher than the 300, just my opinion. And then when you get into your 40s and 50s, I mean, you're making good money, and you're making the most money that you'll make in your lifetime. from 40 to 65. So I believe, and I've got business owners that are utilizing this product for purchasing materials and equipment and buildings. And I've got investors who are doing the same thing, that like to flip houses and purchase real estate. They're utilizing these products. They're stuffing money in there to compound interest so that they can buy more properties and buy things so that they don't have to walk down the street and get a loan from the lender. So
Hey, hold on right quick. Let me stop you right quick. James McManus is asking a question. And I know the answer, but I want you to answer it. If they want to pay a loan back, is there a percentage or penalty they have to pay back?
no.
Okay. I knew that. I knew that answer.
If you want to pay yourself back, you can. The nice thing is that you can choose what you pay yourself back, but you don't have to pay yourself back at all.
Gotcha. That's what I wanted to know. I knew that, but I wanted you to say it to him. All right, go ahead and finish. So now we're on the growth aspect of it. We're a little bit older. People are taking loans out. Go ahead.
Yep, I'd say 600. I've got people who put in 2,000 a month.
Really?
But yeah, because they're so far behind on their retirement. They're business owners. They never did it. They never had the product to do it, and now they don't have a choice.
Gotcha.
And they've got their businesses established. And think about this. So, in my understanding of what happened inside the Rockefeller family household, and I could be totally wrong, but this is what I know to be true from what I've read in my research. But think about this. This is a very good business minded family that still is positioned to create generational wealth today. They had 11 people or more. It might have been 20 people inside their household or inside their family, cousins, brothers, sisters, brother-in-law, sister-in-law, grandkids, nieces, nephews, working for them.
Wow.
That was a very huge family generational transfer.
Mm-hmm.
They took, instead of buying into a 401k or having a retirement plan, he took money out of everybody's paycheck and dumped it into an insurance product, so that when they needed to buy a car or buy a house or get a loan, they came to Uncle Rockefeller, asked him for a loan. He takes out the loan and he just takes it out of their paycheck. And they don't have to pay this interest back to any bank, but he was paying himself and keeping the wealth inside of his family.
Wow. And you can do the same thing with.
How powerful is that? You can do the same thing. You could actually have your sister and your brother and your mother and your father all contribute to this one policy, stuffing money in here and building cash value and creating this cash account for your entire family household, if you wanted to do it that way.
Now, how do you avoid MEC in that situation? I know MEC is probably a little bit different language, a little bit higher language for some.
So let me explain MEC and why that even comes into play. Because
what does MEC stand for first, so I can tell them?
Modified endowment contract.
Okay.
Meaning this: you can only put a certain amount of money away before the government says, "I want my cut." And that's how I say it, because that's how I understand it. I'm a layman, and I just tell it like it is. And I'm sorry, we might get cut off. We may not be able.
No, we're not either. Yeah, baby, not
to broadcast this. But what I will tell you is, it's a modified endowment contract, and when you set the contract up, you have to have some foresight and some understanding of the future and what your value looks like, because you can only put in a certain amount. Now, it's based on how we generate the contract in the beginning. So, for instance, I'm gonna give you an example. In an IRA, the most money you can put in is $6,000 a year. Well, if you take this, if you think about this product, so if you take that $6,000 and you divide it by 12 months, that means you could only put in $500 a month. Well, how can people put in 1,000 and 2,000? Because that's how they set the contract up. Which it's going to give them more play. Like, you can add more money to this, but there comes a time where you can only add so much, because then they know what you're trying to accomplish.
How many policies can a person have at a time?
Many as they want.
As long as they're all set up properly.
As long as they're all set up properly.
So they can be putting $1,000 in 5 policies and just get interest on all of them. Y'all better take this free game she's giving y'all today. And I'm gonna be honest with you, there's an awakening happening in my community, because they're starting to ask these questions. I had a young lady that called me last week, and she said, I want to create an infinite banking. This is her words. I want to create an infinite banking system for my children. And she
Yep.
has a 4-year-old, I think, and a 15-year-old.
Yep.
And now the 15-year-old is different. The 15-year-old is different because he's older. So that 4-year-old had 11-year head start at $75 a month. Now this I ran the illustration. I don't want to show it right now because we're getting ready to come off. I'll show it at a different time. But hold on, I got time. Shoot, hold on.
Well, I was gonna say don't show the name either. So
Okay, let me try to have. I won't have the. I'll have the name this time. I'll have the name. You got on me. Okay, you got me. You got me. You got me. Give me a second. You know I'm not as fast with this computer as you are, but I want to show you the difference. For the here it is right here.
yeah, and I think people need to understand too. If your budget is $200 and you've got a 4-year-old and a 15-year-old, then what you want to do is you want to put more money in the 15-year-old than you do the 4-year-old, because the 4-year-old has a longer time to grow. So in that case, I would recommend you do $75 for the 4-year-old and $125 for the 15-year-old, and you're probably going to come out about even
Okay.
Steven. Okay. Or you just pay in more money longer with the 15 than you do the 4.
All right. So here it is. Let me share my screen. Can you see my screen now?
I can.
All right, cool. So this one right here, this is one, y'all. This is one I started at 16, and he's doing $100 a month, right?
Mhm.
And I think I did it for the same 30 years. Let me look and see. No,
Yep.
yeah, 30 years.
Yep.
There it is, 46.
Yep.
At 46, only putting. See, you see the difference because he's did it at 16 versus 4. He still only put in $36,000, but his account value is $96,000, and his death benefit is $208. But let's go down still to age 70. Hold on.
Or 65,
right.
67.
65. Okay, 65 right there.
Yep.
Am I there? No, there it is. 65. Where is 65? On the left,
It's
right?
right there where the 36. It's right in the middle of the page.
66.
Right under
yeah,
66.
right, 66.
Mhm.
So even at that, his account value, let me blow it up a little bit, is $420,000. What did I do? Oh shoot, I messed up, y'all. I'm sorry. It's my fault. Let me fix it. Okay, one more page up. All right, there we go. At 65, his account value is $420,000, and his death benefit is $504,000. Now that's still good because he only has $36,000 in the account. I mean, where can I go get that kind of return on $36,000? But it's not what his little brother's is, because his little brother started at 4 years old. So the thing, and that's why Chris is saying, instead of putting in 100 now to get that kind of growth, imagine if he puts in 200 at that age. Those numbers are much higher, and it's not just double. It's more than double because of the way the interest compounds. So we have to become smarter about how we set up our families and we set up ourselves for retirement. Don't put all of your faith in a 401k. Look at what the market is doing now. And while the market is doing what it's doing, guess what? All of these IULs, they're all safe because they don't participate in the losses. They only participate in the gains. So we gotta be smart about how we use our money. Chris, I've enjoyed you. I think this is the best one we've had so far. I think this is the best one. Yeah, I think this is.
So. I guess it's just because, this is an everyday thing that we battle. We battle in our mind. We battle bills. We battle struggle. This, in my opinion, this helps alleviate some of the stress that we have as to what's going to happen later on down the line. And I think it gives us some peace in knowing that we can put our money where there's a guarantee. And that's what I love about the product, because the product was designed for this. The problem is that most people aren't educated enough to talk about it. And they just don't know how to do it. So please take advantage of our skills and the fact that we actually do care about your family. We really don't care what we get paid. And we don't get paid on a lot on these small products and the $1 million babies. I mean, we literally get maybe $125 for setting it up. And our
That's it.
time is worth way more than that. But we
Absolutely.
love helping people, and we love helping them create cash accumulation inside of their household so that they don't have to struggle anymore. But it is real.
Absolutely.
Struggle is real.
Absolutely. Absolutely. Listen, I've put my number on the screen. If you have any questions about this, or if you want to set an appointment, I'm going to have Chris give me her Calendly so we can definitely get us on her calendar. If you need more information, I'm not certified to do it yet, but I will be soon. As soon as I get some people who want to do it, and we'll go ahead and we'll get ourselves set up. I can take care of you on the Index Universal Life Insurance policies, though. And if you want to just a quote. If you want to look at an illustration, look at see what the growth looks like, let's do it. If you're overfunding your 401k, stop it today. Go in, find out what that is. If your match is only 4% and you're giving 7 or 8%, hey, stop it. Don't give that tax money away. Let's figure out how to combat the taxes that you're going to pay in the future. Tax deferred doesn't mean tax denied. You're still going to pay taxes at some point.
Yep.
And you're going to pay a lot more in the future than you will pay right now. So let's go ahead and start creating growth. Take that extra money and create some growth with that money so that when you retire, you'll be able to supplement. Use your 401k for what it's worth. That's free money. No, don't turn it down. But when you can create growth with the rest of it, you see how Chris is smiling. She's smiling because she knows I'm learning this stuff, and she likes to hear me be able to talk about it, knowledge it. So she's smiling at me because I am her little protege. So she's well, not little, but she's trying. She's surprised I'm learning this stuff. But if you listen long enough, you should start to figure this thing out. Really, y'all don't know the conversations that we've had, multiple conversations over and over again about trying to run these illustrations and all this stuff. And now I got it. I can do it. So I want to help you. I want to set. I don't just want to set. And that's what that young lady did with Chris the other day. She first of all, she didn't want to throw money away with term life. That was her word. I don't want to throw it away. So she was willing to. So how we got her set up stability wise is we gave her a universal life policy to get started because the death benefit was important to her. Right. So she wanted to make sure she set up $200,000 for her kids. So we did a universal life for that. Then we built her portfolio by putting in $75 a month for her 4-year-old, $100 a month for her 16-year-old. So now she has $175 plus $145 or something like that. $330 a month going into an insurance policy, and all of those are cash building accounts. Yep, they're cash building accounts. So it makes sense. It's not a payment; it's an investment. And that's what we have to learn how an investment should give you a return at some point. Now, that universal life is not going to give you the same compounded interest like a IUL, but it's not created for growth. It's created for the death benefit. You wonder why you're able to buy an insurance policy $500,000 for $50 because you're young, you're healthy, and you probably ain't going to die. So that's the mortality says you're probably not going to die. So you're going to pay $50 a month for 30 years and you're not going to die. I mean, it is what it is. If you do, God bless you. Hallelujah. Move on. Your family gets it. But most of the times you're not going to pass away. That's why they're selling you something like that. Let's create. Chris, stop laughing. Am I telling you? If I'm lying, tell me I'm lying. Please tell me I'm lying.
No, it's just the funny thing about it is that nobody wants to talk about it. And I mean, we're human too. The day you're born is the day your ticket's already punched. You're not going to evade death. The question is are you going to be set up properly? That's the only question I have for you.
Yeah, that's a real good question. Are you going to be? And that's a good way to segue out. Let me turn my music on. Right? See, Chris, I didn't show you this little thing I got. Now I can turn the music. Got me a new song. Watch this. You hear my music in the background? It's light. Hold on, I'll give you a little bit more. So we can stay on and we can keep talking. So basically, if you all want to get set up properly, please contact me. My phone number is on the screen. I'm James Kirkland. I want to help you get your portfolio set up. Let's take $75, $100 a month. If you're young, got a child, let's go ahead and get them set up. Let's get you set up. If you're putting $1,000 a month in a savings account and you're not getting any interest on that, we can talk about the rule of 72. We'll talk about that a little bit more next time. But it would take forever for your money to double. Forever. At 0.25%, it'd probably take, about 400 years? I mean, somewhere around there. But anyway, it'd take a very long time.
Yes.
But if we take 7% compounded interest, and that's what these policies usually do, somewhere in that neighborhood, because we invested in the S&P and the Barclays, and you usually get somewhere close to 7%. So if you want to get yourself set up properly, let's do it. Let's do it. Give me a call, 470. Shoot me a text. I would shoot me a text first, and then I'll probably answer it. But give me a call, and we'll go ahead and get you set up. If you're interested in retiring your debt, we just showed you. Go back and do the replay of this if you need to. We showed you how to trim 11, 12 to 13 years off of a 30-year mortgage by just taking what you're paying now and reapplying it and putting it in buckets. And every time that bucket gets full, we pay off a debt. It's a simple principle, but you're using life insurance to get it, and we can help you get set up. So, as I always say, Chris, you have any parting words before we go?
Nope. Just get your family set up, and let's change the mindset and education, and let's change the future.
Absolutely. And remember this, as I always tell you, that the world is changing. My question for you is, why do you remain the same? Y'all have a good day, and we'll catch you next time when we talk about insurance with James and Chris TInsman. Y'all have a good day.